Are you always updated about anything to do with Tesla stocks? Did you know that there is a huge warning for Tesla stock investors? Make sure to stay tuned and keep watching to find out what that is. A lot of people keep their eyes on Tesla stock. Given the present economy, investors are kept on the edge of their seats waiting for news on how well stocks are performing. Investors and analysts alike make educated predictions on stock performances and relay them to anyone interested to know via interviews, articles, news, or posts. In today's video, you'll see how a Tesla bull gave a huge warning to Tesla stock investors. Tesla, an American automotive and clean energy company based in Austin, Texas, designs and manufactures electric vehicles, battery energy storage from home to grid scale, solar panels and solar roof tiles, and related products and services. Moreover, Tesla Inc. designs, develops, manufactures, leases, and sells electric vehicles and energy generation and storage systems in the United States and other parts of the world. The company operates in two segments, automotive and energy generation and storage. Tesla bulls are betting on the Tesla of tomorrow. Among other things, bulls are buying because of the prospect of a future robot taxi network controlled by Tesla, a shift in the preference from ICEs to EVs, growth in the Chinese market, and the simple fact that they think Tesla produces a terrific car. A certified Tesla bull, Morgan Stanley, dropped a huge warning to Tesla stock investors. Morgan Stanley is an American multinational investment management and financial services company headquartered at 1585 Broadway in Midtown Manhattan, New York City. Morgan Stanley mobilizes capital to help governments, corporations, institutions, and individuals around the world achieve their financial goals. Moreover, Morgan Stanley is a leading global investment bank and wealth management firm, employing more than 60,000 people worldwide. The company makes money primarily from three main units: institutional securities, wealth management, and investment management. A new research update by Morgan Stanley states the MACC, Tesla and the Great American Onshore Battery Capex Cycle. MACC stands for Mother of all Capex cycles. According to the said research note, Morgan Stanley believes that Tesla's role in building out the U.S. and Western European renewable energy infrastructure is underappreciated. According to them, war plus inflation equals energy innovation. Global markets are firmly in the grip of inflation. Inflation is a powerful catalyst for innovation, rivaled by war. The lack of energy supply, both structural and idiosyncratic, renewable and fossil, ranks high among global challenges. Re-architecting the global renewable energy infrastructure and supply chain will require as much as 20 to 40 terawatt-hours of battery capacity and $10 to $20 trillion of accumulated capex spend through 2040. Morgan Stanley believes names exposed to this capex cycle can drive powerful alpha in one's portfolio. The old economy, long out of favor, heavy industrial names that make stuff, move stuff, and dig stuff out of the ground may be poised for a renaissance. Concerning Tesla, they think attributes like AI, autonomous, and EV are fully appreciated, if not overappreciated. They also emphasized their belief that Tesla's more gritty capabilities in terms of manufacturing, material sourcing, supply chain, and infrastructure will drive the next leg of growth in the story. However, some people may raise eyebrows or even express dissatisfaction with Morgan Stanley's statement that Tesla's AI abilities are already full. Still, Tesla's prowess as a tech company is known. In fact, it can be argued that Tesla is still the leading company in the EV industry. However, Morgan Stanley lowered their 2022 volume forecast from 1.46 million units to 1.43 million. This is pretty understandable, as the Shanghai plant ceased operations for a while because of COVID-19. But Tesla has since been striving to meet its target numbers. In fact, they recently opened and started manufacturing vehicles in the Austin and Berlin plants. Morgan Stanley also lowered their 2022 gross margin from 28.1% to 26.8%, excluding zero-emission vehicle credits. According to them, the decrease reflects their view of inflationary pressure cutting into the margin in the remainder of the year. They also anticipate price hikes from Tesla's battery cell suppliers that were not fully reflected in Q1 results due to timing differences. Keep in mind that these are Morgan Stanley's predictions, and Tesla stocks may or may not perform according to these predictions. With regards to cash flow, Morgan Stanley estimates that Tesla will generate approximately $9 billion of free cash flow in the present year and thus rise to $27 billion of free cash flow by 2025. Before we continue with the video, make sure to hit the like and subscribe button as well as the bell notification to be updated to our videos. Going back, Morgan Stanley's warming comes off from the predicted volatility. They stated, "We fully expect Tesla to trade with the market in the weeks and months ahead, and there are clear areas where we wish market expectations would be lowered." Of course, they provided a basis for this statement. For one, they think the core automotive margin is too high at this point, and it does not fully reflect input cost inflation. Secondly, they believe expectations of full autonomy or FSD flipping into a major near-term margin boost are overestimated, and in fact believe that Level 4 and/or Level 5 autonomy at scale is well over a decade away. They also stand by their belief that Tesla's long-term future in China is highly uncertain. They do see some scope for Tesla to potentially retain an ownership umbilicus of a Chinese-controlled Tesla unit, but the path may be very winding and unpredictable. They also added more details on their change to the valuation model and stated, "While our 1,300 price target is completely unchanged, the composition has changed in a material way. We reduced the core automotive valuation to $608 per share, down from $646 per share, and we reduced network services to $338 per share, down from $393 per share. Offsetting these reductions, we increased Tesla Energy to $111 per share and Tesla third-party battery to $131 per share. We increased our WACC, or weighted average cost of capital, to 8.5%, up from 8%, to reflect a rising risk-free rate which had a negative impact across all divisions of approximately $120 per share collectively." Again, note that these are just predictions and warnings from Morgan Stanley, and it is upon your discretion whether you believe these statements or not. In fact, a footnote on the research page just discussed states, Morgan Stanley does and seeks to do business with companies covered in Morgan Stanley research. As a result, investors should be aware that the firm may have a conflict of interest that may affect the objectivity of Morgan Stanley research. Investors should consider Morgan Stanley research as only a single factor in making their investment decision. Adam Jonas said that the company was a winner in the electric vehicle (EV) race. Adam Jonas is the global head of autos and shared mobility research at Morgan Stanley. He said that the current landscape for electric vehicles was a race and that Tesla was winning it. "Think of the EV race as a marathon," he wrote. "Tesla is in the lead at mile number 21. Everybody else is at mile 2 or still tying their shoes." According to Jonas, recent record deliveries of its cars were proof that Tesla's position will become stronger as the marathon progresses. Earlier this year, he revised his price target for the automaker's shares to $1,300 from $1,200 and predicted delivery figures of 2 million for 2022. Tesla delivered 936,000 vehicles last year and plans to increase that figure by 50% this year. Analysts and investors have differing opinions on Tesla's current standing in the stock market, but a lot of them remain bullish and believe that the stock is a good long-term investment. That said, given these predictions from an established financial services company, it depends upon you whether you are willing to take a risk and invest in Tesla stock, or if you already are a Tesla stock investor, you will have to think through whether to continue with this venture. Again, these are just predictions, and you are very much welcome to conduct your thorough study. After all, it is your hard-earned money at risk, whether you sell off or buy in stocks. According to CNN Business, the Tesla stock price forecast is presented as, the 36 analysts offering 12-month price forecasts for Tesla Inc. have a median target of $1,000 with a high estimate of $1,620 and a low estimate of $250. The median estimate represents a plus 14% increase from the last price of $703.54. Moreover, the current consensus among 43 polled investment analysts is to buy stock in Tesla Inc. This rating has held steady since May when it was unchanged from a buy rating. Remember that investing in stocks comes with certain risks, but good profit. Note that investing money in stocks is a risk, even from the beginning, which is why it is very important that you study market prices and the performance of the stocks you have your eyes on. Visit our channel and watch our other videos if you enjoyed this one.